In this session, I will cover key profitability ratios: EBITDA margin and net profit margin. As the name suggests, profitability ratio measures profitability of the company. It helps to assess performance of the business and how well company is making use of its assets to generate profit. There are 4 main profitability ratios. However, in this session I will focus on profit margins, EBITDA margin, and net margin. Many stock investors use operating profit margin to find out how much of the revenue company is converting into profit. There is a slight difference between EBITDA margin and operating margin which will be covered in separate session. You should understand the income statement before you delve into margins and ratios. Let's revise quickly. The first line on income statement is always the revenue. Revenue is further divided into 2 line items: revenue from operation and other income. Revenue from operation is the revenue generated by company from core business activities. Other income is generated through activities like interest, dividend, and activities apart from core business operation. The next line item is expenses. The expenses are classified under several line items. It is the expenses associated with manufacturing and selling products or services. The next line item is profit. Profit before tax is calculated as total revenue minus total expenses. Next line item is net profit or profit for the year. You arrive at the net profit after deducting all the applicable tax from profit before tax. Now it's time to understand profit margin. Let's start with the EBITDA margin. EBITDA stands for earnings before interest, taxes, depreciation and amortization. It is the profit before subtracting expenses associated with interest on debt, taxes to the government and depreciation and amortization. You can calculate EBITDA using one of this formula. Both the formula will yield same results. Now, it's time to calculate EBITDA margin. It is calculated as EBITDA divided by operating revenue. Operating revenue refers to the total revenue minus other income. Other income is generated through activities like interest, dividend, and activities apart from core business operation. Hence, we have to exclude other income from total revenues to reflect true earning potential of the company. Please remember, you have to multiply result by 100 to express EBITDA margin as percentage. A financial ratio on its own conveys very little information. It always makes more sense to compare the company's margin versus its competitor. You can also compare margin across years to see if company margin is improving or deteriorating. High margin indicate lower operating expenses in relation to total revenue. I would prefer companies with high margin, which is a clear indication of competitive edge. Let's review this example. It shows margin for Company A and Company B across 4 years. Company A has volatile margin. It shows business is not predictable and so is stock. However, Company B is clearly standout with nice increasing margin trends across years indicating operational effectiveness. It's very easy to understand net profit margin. Net profit margin is a profitability ratio that calculates how much percentage of the company profit is left after deducting all the expenses. The formula for net margin looks like this. Net margin is an important ratio to analyze before making investing decision. High net margin indicates management is effectively able to control the cost and sell products or services at a price significantly higher than its costs. Let's review net margin with example. It shows net margin for Company A and Company B across 4 years. Company A has high net margin that shows strong competitive advantage. However, Company B is clearly in competitive industry resulting into low net margin. If you are looking for stock investment, it's important to review EBITDA margin and net margin trends across the year. You should also compare with companies across same industries or business model to ensure your business has competitive advantage. Thank you.